Everyone has been asking the same question: how to win in option trading? What is the best kind of stock to use for real strategy? Should you go for high volatility tickers with those juicy premium, or stick to safer, fundamentally strong companies that won't give you sleepless nights? The truth is, both can work, but only if you understand how and when to use them. So in this video, let's break down how to choose the right type of stock for the whale and the key metrics I personally look for. And I'll even walk you through a few real examples: the good, the bad, and the ugly. When it comes to choosing stocks for the whale strategy, there are generally two primary approaches trader likes to use. The first, and by far the most common, is the high volatility approach. These are the stocks that move a lot. Their prices swing up and down, and sometimes dramatically, and because of that movement, the option premium tend to be much higher. It's exciting, right? More movement means more premium income. And if you are running a small account, these stocks can seem very attractive. They are often cheaper per share, meaning you can start trading them without needing a huge amount of capital. And on the surface, this sounds perfect: more volatility, more income, faster compounding. What's not to love? But here's the thing most traders overlook: that volatility usually comes at a cost. When a stock is volatile, it is usually for a reason. It may be a company that is not profitable yet, or one that is still trying to prove its business model. Or maybe it's just a hype driven stocks that the market can't quite evaluate properly. And while you might be collecting nice fat premiums at first, that only lasts as long as the stock holds its value. Because if that company fundamentals are weak and the share price keep trending down, eventually you'll get a sign and finding yourself holding shares that are losing value faster than the premium you collected. So, yes, you might see income flowing in every week from your option trades, but behind the scene, your portfolio could slowly be bleeding out, turning what looks like steady income stream into long term loss. That is why I personally prefer the second approach, focusing on stocks with strong fundamentals and steady long term growth. Remember, the whale strategy is still fundamentally bullish. You are essentially betting that the stock will either stay stable or trend upwards over time. When you sell a cash secure put, you are basically saying, I'm willing to own this stock at a lower price. So, if you did get a sign, your ideal outcome is for the stock to recover. And that only happens if the company itself is healthy and growing. This is why the quality of the underlying stock matters more than the premium you collected. You are not just trading option, you are taking a stake in real businesses. A simple guidance: look for companies with consistent revenue and earning growth, and price chart that show resilience and recovery through past market downturn. Let's take a look at Amazon as an example. If you check its income statement, you will notice years of steady revenue growth and consistent profitability. Now, take a look at the chart. Amazon has weathered multiple major market events: the dot-com crash, the 2008 financial crisis, the 2020 pandemic, and even 2022 bear market. And each time it bounced back. This kind of track record show resilience, which is exactly what you want when using the whale strategy. Google tell a similar story. It's not the most volatile stock, but it provides solid option premium, generates massive free cash flow, and have a proven history of recovering after market dips. These are the kind of stocks that reward patience, they allow you to collect steady income, and if you ever get a sign, you will feel comfortable holding them for the long term. Now, let's talk about some riskier stock. Take Palantir for example. It's company that started with a lot of hype but no profits. For years, it was losing money. It wasn't until 2023 and 2024 that it finally turned profitable. Only after that, the stock began to trend upwards. Then there's Tesla, a strong brand with a loyal customer base, but its profitability has been inconsistent. Much of its stock movement is driven by Elon Musk and market hype rather than steady business performance. If you were running the real strategy doing one of the jobs, those juicy premium will not have been enough to offset losses from the stock itself. And of course, there's GameStop, a classic meme stock that behaves more like a lottery ticket than a traditional investment. The price chart looks more like an ECG monitor with random spike followed by a long period of flat movement. That kind of volatility might look exciting on paper, but for a disciplined strategy like the whale, it's practically a recipe for chaos. So here's the key takeaway when picking stocks for the whale strategy. Balance is everything. You will need enough volatility to collect attractive premium, but you also need enough quality that if you get a sign, you feel confident holding the shares long term. This means focusing on profitability, fundamentally strong companies, businesses that generate consistent cash flow, grow their earnings, and have a track record of bouncing back after market downturns. Stocks like Amazon, Google, Microsoft, and Nvidia fits this description perfectly. They offer solid premiums, stability, and potential for long-term growth. At the end of the day, the real strategy isn't just about chasing high yield. It's about creating a sustainable approach, leveraging options to boost return while protecting your capital. And that is my approach to picking real stocks. Focusing on companies with real growth, solid company, and lasting resilience. If you find this guide helpful, make sure to give a like, subscribe for more option trade insights, and share in a comment which stock you have been using for the real strategy lately. Thanks for watching, and I'll see you in the next one.